Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 324th VideoCast podcast for the week ending January 1st, 2026. Welcome to the new year. Happy New Year, everyone. Interesting week. Had a little food poisoning incident. That's the bad news. The good news is this will be the first year ever that I achieved one of my top 10 goals for the year. On the first of the year, I hit my target weight basically overnight. Turning a negative into a positive for sure, but it's good to be back. And as always, family first, then we'll get down to business. I want to congratulate Annabelle Hayes, who was recognized by SwimSwam, the #1 swimming publication in the world, for the 2025 Swammy Awards Age Group Swimmer of the Year for 10 and 10U. And here's what they had to say. Annabelle Hayes from Irvine Nova Aquatics recently turned 11, but she had an electric 2025 as a 10-year-old. At the conclusion of the 24-25 SCY season and the 2025 LCM season, she held top 10 times in the 18 events and the top time in the country in 11 events. It's unbelievable. Top time in the country in 11 events. While she had a strong short course season, which finished with her leading the country in 3 events, the 100 free, 500 free, and 100 back, her long course season was where she made her mark on the all-time rankings. The only stroke where she didn't hold top 10 times was breaststroke, but in long course, she was the top swimmer in all 4 track distances of freestyle, both backstrokes, the 50 fly and the 200 IM. She set the second fastest times in history in the 100 back, where her 109.72 was just 4/10 off of Miriam Sheehan's 2025 NAG record time of 109.36, and in the 200 IM, where she swam 229.87 to miss Kayla Hahn's 2019 record of 228.70. She also moved up to 14th in the 50 free, 28.90, 4th in the 200 free, 215.42, 6th in the 400 free, 442.04, 20th in the 50 back, 33.31, and 9th in the 50 fly, 30.82. Hayes was also a member of 2 NAG record relays in 2025. Irvine Nova Aquatics broke the 10 and under SCY and LCM records in the 200 medley relay, and Hayes was the backstroker on both relays. We don't have splits for the short course relay, but she led off in 34.25 on the long course relay. So super exciting. Really proud of all the hard work she's doing, and nice to see top time in the country in 11 events. Swimmer of the year. Way to go, Annabelle. All the hard work is paying off, and moving out to Cali was worth it. And Mimi's taken full advantage of that as well. We'll have more to share on her developments in coming weeks. But we got to spend some time in Disney, which was a lot of fun. That's the girls with Caitlin's dad, my father-in-law, Steve. That's the girls celebrating New Year's Eve last night at the club. I didn't make it to that one. I was kind of recovering from couple off days after that surprise event. Here's some more at Disney, and then a couple here, and then we'll get down to data and business. There's the girls at the aquarium in Long Beach this weekend. Jellyfish there, pretty cool stuff. And then finally Christmas Day with the doggies, and a little walk in CDM. Christmas Eve at nothing more glorious than the view of scattered wrapping paper all over the floor, as Andy Rooney used to say. Treasure it. And then on Friday, I had the privilege to join Varney & Co. Want to thank Garrett Collins for having me on. I was on with Ash Webster, and we launched our newest healthcare position that everyone's been waiting for. So we're going to listen in here. You're going to love this one.
For you. It's all been very quiet this morning. We're about 30-odd minutes into the session, and all of the markets flat to just ever so slightly lower. Be interesting to see how the day pans out. Thomas Hayes joins us now. Thomas, you don't think any of the Max 7 stocks are going to double in 2026. Tell me what you think about it. Why?
Well, Ash, I think 2026 is going to be the year of opportunity mixed with difficulty. Our target price at Great Hill Capital is 7,300 for 2026, which is only up 6% from here. more volatility, some 10% corrections, but more opportunity under the surface than ever. So we are not bearish. There will be more stocks up 50 to 100% next year. They just won't be found in the current top 10 weights in the S&P 500. I would venture to say, Ash, there will not be even one Magnificent Seven stock that doubles in 2026. The real money is going to be made under the surface in cyclicals that benefit disproportionately from the easing cycle. More cuts, $40 billion a month in bond buying through April, fiscal stimulus from the tax refunds going up 1,000 to 2,000, and possible dividend payments from the tariffs along with the warrior checks to our active military. So we're going to see those ISM manufacturing surveys back in expansion over 50, but the cyclicals are going to benefit industrials, material, and energy over the Mag 7 and what's worked in the rearview mirror.
All right, I want to get onto this stock. I don't know how you pronounce it. Is it Dentsply Sirona? Dentsply Sirona. The stock ticker is X-Ray. Tell me about this. Why do you like it?
Okay, this is a turnaround Tom special. This is a brand new position for Great Hill Capital in recent days. It's trading at 7 times forward earnings. They've got $3.6 billion of revenues, and they are the #1 maker of dental supplies and technologies. They're around since 1899, so they've been doing this for a while. It's a very cyclical business, Ash, and we are in the trough of the cycle. The stock is down 83% off its 2021 highs. They've got a 5.78% dividend, which is great, by the way. You can get paid while you wait. It's also great as a margin of safety of a turnaround story. If they cut the dividend, they've got an extra $120 million of free cash flow if they need it. I don't think they'll have to cut the dividend. This stock, in our view, over the next 3 to 5 years, could be a triple. They've got a brand new CEO in Daniel Scavia. He was appointed in August. In his last position at Globus Medical, which was a public company, the stock was a four-bagger over his 10-year tenure. So we like this one.
I can hear that in your voice. Tom Hayes, great stuff, Tom. Great to see you, and Merry Christmas to you. Coming up, Jasmine Crockett is...
So that one, Dentsply Sirona, has become a very large position very, very quickly. And we're excited about that. We'll have more to say about it in coming weeks. And want to go through some of these bullish percent charts so you can see sector by sector where we are this week and how we're headed into the new year. You can see this basically is bullish percent. What that is, that's a point and figure thing. We don't use point and figure, but it shows the amount of stocks that are in bullish positions based on this technical indicator. Communication services, it's only 55%, so we could see some follow through that we didn't see in December, in early January. NASDAQ composite is kind of towards the top end. Consumer discretionary is towards the top end, but not stretched. Energy is weak. We're going to talk a little bit about that. As a matter of fact, I want to just jump right to the energy chart here. This is crude oil. We've talked about the commitments of traders for many years, and the commercial hedgers are often early and often correct. And what we see here in the green line below on the weekly chart is that they've been buying contracts like it's going out of style. And you can see those times where it gets to the extreme. You get at least a bounce and sometimes a trend reversal, big upside in oil. This time past year was, $10. Here was a big trend reversal in 2020. That was a big tell for us. This was in 2019, et cetera. And we're lined up for there. So I do think you're going to see a little bit of above trend inflation, something 3% in 2026. And some of that's going to be oil now coming into the picture. I know that's counterintuitive, but the commercials tend to tell the whole story. Let's take a look on the monthly. You can see here, again, extremes that you see before big moves. So energy's going up. Financials has moved here, bullish percent. So there's probably not a lot of juice in that right now. Gold miners has been extreme. Healthcare is kind of in the middle zone, 60. Dow has more room to run. The industrials down only at 55%. That's probably got some juice here in the first quarter. Infotech, some of those are going to start to bounce back. Materials, same thing. So you can see, as expensive as the market feels, there's a lot of opportunity still to be had, and we're going to go into some of the data here. Real estate, that's going to be a function of rates, which is going to be a big deal in 2026. We did get, by the way, very close. I thought we would see 5.99 on the 30-year fix before the end of the year. We got to 6.15, not bad. Here's S&P bullish percent at 60. So we could have a little more follow through in the first quarter here. Staples just getting going, so we like that. And utilities has been left for dead. There's nothing really in utilities that we love at the moment. Then I want to look at the relative sector charts. This is US dollar to the S&P 500 relative performance. It's been weak. It's going to get weaker, ladies and gentlemen. Weaker dollar in 2026 will continue. We'll have some counter trend bounces. Gold miners to S&P has been through the roof. I would say it rarely gets to a ratio higher than this. So if you've made some money in gold, count your blessings. I'm not telling you, this is all opinion, not advice, but I wouldn't be a buyer here. Biotech had a huge run in 2025. We took some profits there so we could get money for Dentsply Sirona. That'll probably work higher anyway, but Dentsply we think has higher IRR potential over the next 3 years, much higher. U.S. aerospace and defense relative to the S&P has had a big run. We love our Boeing. No changes there. Small caps just getting off the mat. We love this theme for 2026. They benefit from the easing cycle. They benefit from lower rates, and that game is just getting started. Real estate, again, down because of rates. That will change in 2026. And NASDAQ has been strong, or QQQ has been strong. We think that's going to level off in 2026. And home builders, this is a rate play as well. We think that this relative double bottom should hold, and we should start to see a recovery in housing, home builders. But more importantly to us is the derivative plays like the QXO, building supplies, like Stanley Black & Decker, like Generac, which will get more bang for the buck than buying the race to the bottom in margins in home builders. This is materials relative to the S&P. We had a huge run on Albemarle in 2025. We think that trend is going to continue, albeit at a slower pace. Looking for some more exposure to materials. There's energy, just waiting for the next move higher, consolidating the gains off the 2020 lows, and ready for its next leg higher of a secular bull. Financials, nothing we love there. We still like it through PayPal, downside protected, upside really unlimited. We love this story in 2026. There's tech. Staples just getting off the mat. That's going to be a key theme. Defensives work in midterm election years. This is going to be no different. Utilities down on the mat. Again, that's related to rates. And healthcare started to rally the end of the year. Going to continue in 2026. Consumer discretionary opportunity there. That started to work before the end of the year as we anticipated. And that's that. So what are the key themes for 2026? Number one, do not expect big returns in 2026 if you're sitting passively in indexes. Midterm years average since 1948. NASDAQ is negative 0.5%, S&P 4.6%, Dow Jones 5.2%. Obviously, this all depends on the year you start. If you start in 1950, the S&P goes lower. The point is, they're not great numbers if you're just passive. However, do expect big returns in 2026 if you're focused on the right areas that benefit most from an easing cycle and weaker dollar. Fed easing cycle, we got cuts plus new QE. They're actually now expected to buy $220 billion in T-bills in 2026. That's QE, not light. That's real QE. Cyclicals will benefit. Dividend payers will benefit. Companies with significant portion of their revenues will will benefit as the weaker dollar persists. In addition to easing, federal tax refunds are expected to jump by up to $158 billion year on year, which also favors cyclicals. Couple that you know, GXO Logistics, 75% of revenues come from outside the U.S. That's a cyclical that will benefit from these conditions. And National Oil, well, Varco, the energy services, it's not only a cyclical dividend player, less sensitive to the price of oil, billion on the balance sheet, billion of free cash flow, 1.5 billion of debt, best positioned in the group, in our opinion. Warren Buffett, look at market fluctuations as your friend rather than your enemy. Profit from folly rather than participate in it. And then we have Seth Klarman. It turns out that value investing is something that's in your blood. There are people who just don't have the patience and discipline to do it, and there are people who do. So it leads me to think it's genetic. I think that's absolutely true. The older you get, the more you realize it, and that's that. I want to thank everyone who has been sharing the podcast, which has made us top rated in the hedge fund category. Easiest way, look, many of you have made a lot of money off the ideas on the podcast and become clients. We're very grateful for that. Some of you aren't at that level yet, and you have reciprocated by sharing it with one or more people that you care about, that love the markets, that could benefit from this content. We thank you for that. Please continue to do that in 2026. One easy way to do it is get the merch, wear it. People will ask you about it. And then we'll get you on the page with all these other awesome people in the Hedge Fund Tips community. Let's get down to data. There are 37% more home sellers than buyers. So this is to what we had talked about last year, turning out to be a buyer's market. And that will continue. It's going to be the opposite of what everyone's expecting. People think when rates go down that prices will go up. It's going to be the opposite. Massive supply is going to hit the market, and that's going to be a great thing for affordability. We look at ISM manufacturing services, the PMI. This, as a result of the easing cycle, we believe is going to accelerate back above 50 into expansion. That is going to be an enormous boon for all of the cyclicals. It's going to be a big, big time for that. Wanted to just highlight Daniel Scavia's bio. He's the CEO of Dentsply Sirona. He spent 10 years at Globus Medical, where he was first the CFO, then the chief commercial officer, then the CEO. And during that 10-year period, Globus was a four-bagger stock. Prior to that, he was at J&J. He was at several other major companies, and now he is the new CEO, which is one of the key components for our turnarounds with the Catalyst, and we really like what he's been saying on the first two calls. A friend who is a direct competitor gave me a tour of his factory and helped me understand the business and enabled us to have some confidence to make it a nice size position pretty quickly. And we're excited about that one. So more to come on that. Here's the current state of the mortgage market: 615 on the 30-year fixed, 544 on the 15-year fixed. This is PayPal, total shares outstanding, and PayPal buyback yield. You can see the shares outstanding have gone from 1.1 down to 940. The buyback yield is now about 10.5% per year. So every year, your position in the company gets close, 10.5% larger without putting in new money, and the business is turning at the same time. We love that story. In 2026, household income versus median home price. This is where we're going to see affordability drop back in 2026, as we've talked about. Let's get to some of the key here. Consumer staples positioning, dramatically underweight. We love that theme in 2026. Here are year-end targets. We're at 7,300 on the S&P 500, which is only 6% from current levels. We think all the money is going to be made under the surface this year. You got Oppenheimer at the most bullish at 8,100, and you have Stifel the most bearish at 7,000. Total housing inventory is now ticking up. That's going to be another contributing factor. Here's an important article from Financial Times. If the subsidy war drags on, Bernstein estimates Meituan's cash on his balance sheet will fall to RMB 74 billion next year, down from 110 billion in 2025. Alibaba's deeper pockets with 547 billion RMB cash give it room to keep pressing its advantage next year. Meituan's share of the instant delivery market is forecast to fall from 73% in 2024 to 55% by 2027, while Alibaba's will rise from 21% share to 40% share over the same period, according to research by Morningstar. Alibaba's renewed fight comes as it pushes to become China's leading everyday app for transactions across goods and services. Alibaba wants to weave together the entire consumer internet, what you buy, where you go, what you search for, into a single integrated ecosystem. With that, it can cross-sell everything from takeout meals to travel bookings and fashion. Dinping is facing strong competition from Alibaba's mapping and navigation service, Amap, China's fourth most used app with 890 million active users. So that's exciting stuff. They are being aggressive. I remember a few years ago, I had a discussion with an analyst group that was was building a big position in Meituan. I said, you need to buy Baba. They went with Meituan. Needless to say, they're out of Meituan, and Baba's up big time. Here is the Hang Seng Index. You can see here it's this sideways consolidation and this reversion before a big move up. So we've got a lot more to do in China through our Alibaba position in coming years. Nominal GDP has rebounded huge. That's positive for profit growth. M2 money supply is still above trend. This is the chart about the long-term, midterm election year results for the indices. Healthcare, by the way, if you look at the NASDAQ at 0.5, healthcare is plus 9% in midterm election years. And higher market concentrations heightens risks. We agree. We're avoiding those overly crowded areas of the market, and that served us well in 2025. It's going to serve us even better in 2026. The RMB has strengthened against the dollar. We've been talking about that was a key component 2 years ago when we were pounding the table. We've now seen that. That's going to persist. Federal tax refunds expected to jump 44% in 2026. That's hugely stimulus for consumer discretionary like Papa John's, which we're going to cover. As a matter of fact, we have a special guest. Our analyst, Jeff Adams, is going to cover the analysis of this new position in just a few minutes. So hang tight for that new edition. We're excited. Jeff has been learning through the podcast for 4 years. Been with us now for some time, full time, full tilt now, and we're just excited to have him part of the team as we continue to grow. And he's doing a great job. So, China internet giant shares logs strongest year since 2007. Okay, so that was on not many people's bingo cards last year. Except for those amazing viewers at Hedge Fund Tips with Tom Hayes. I think we're going to see more good things in 2026 on that front. Federal Reserve injected $16 billion of liquidity. That was December 30th. So they are in the game again, full tilt. It's good to see. And see. European stocks cap best year since 2021. That's the international theme we've been talking about. Dollar set for worst year since 2017. We were one of the few people calling that at the beginning of last year. So you guys benefited from that. Here's the 6th years of presidential term seasonal pattern. I'm not sure how that's relevant. We'll keep that out. Oh, I see. They're trying to say it's Trump's 6th year without the gap. That's kind of a tenuous argument. But I do like this pattern for next year. A little bit of strength in the first quarter, weakness into the election, and then strength in year end, and a flattish type of year for the indices. New home median price is 3% lower than existing home price in August. Not so magnificent in 2025. Yearly returns for each Mag 7 stock in the S&P 500. We've been calling that for a while. Amazon was only up 5%. Apple, similar story. Microsoft, Meta, all underperformed the indices. Volumes are a little frothy on the option side. Stay out of the crowded areas. Here are some key sayings from the master, Warren Buffett, who retired yesterday. Tremendous influence on my life. I wouldn't have this career if not for his generosity of sharing, which is part of the reason that we've done these podcasts. We're sharing in our own way, not to say that we're providing the type of value that Warren Buffett could have, but we try to provide our best every single week. Here's some of his quotes. To my fellow shareholders, I will no longer be writing Berkshire's annual report or talking endlessly at the annual meeting. As the British would say, I'm going quiet, sort of. Greg Abel will become the boss at year end. He's a great manager, tireless worker, and honest communicator. We wish him an extended tenure. Greatness is defined by kindness and service, not wealth, fame, or power. Greatness does not come about through the accumulating great amounts of money, great amounts of publicity, or great power in government. When you help someone in any thousands of ways, you help the world. Kindness is costless, but also priceless. Whether you are religious or not, it's hard to beat the golden rule as a guide to behavior. That's from Warren Buffett. Mistakes are part of life. Perhaps self-serving observation. I'm happy to say I feel better about the second half of my life than the first. My advice, don't beat yourself up over past mistakes. Learn at least a little from them and move on. It's never too late to improve. Get the right heroes and copy them. You can start with Tom Murphy. He was the best. Live a life that will make you proud of your obituary. Quote, remember Alfred Nobel, later of Nobel Prize fame, who reportedly read his own obituary that was mistakenly printed when his brother died and a newspaper got mixed up. He was horrified at what he read and realized he should change his behavior. Don't count on a newsroom mix-up. Decide what you would like your obituary to say and live the life to deserve it. And that's from the greatest, Warren Buffett. Okay, moving on to some headlines. Hong Kong stocks logged best year since 2017 as AI boom fuels tech rally. Xi declares China's economy set to hit 5% growth goal in 2026. Wait, 2025. Oh, I see. Okay. What he called an extraordinary year. China unveils $51 billion in early spending to support economy. Beijing renews trade-in subsidy scheme amid domestic car market's gloomy outlook. Kind of cash for clunkers. Remember, DeepSeek, China could have a new NVIDIA threat. Again, they backtracked. They're now selling the H200 chips as of December to China. That was a mistake made originally by the Biden administration and followed through with by the Trump administration. They've now backtracked on that. You took them from being dependent and giving us money to independent and taking money from us. So they realized that was a mistake. Trump wants a weaker dollar. Some Chinese say he has a point. He is getting the weaker dollar. AI next leg is all about tech pick and shovel stocks. I think you go past that, AI beneficiaries, which we've covered many times on the podcast. Reason I'm bearish on tech stocks. This is from Jeffrey Petak over at Morningstar. You should check this out. Obviously, the concentration, expected returns after the years that they've had. And it's just not beneficial to chase what's crowded. Rarely do you outperform. Monetizers versus manufacturers, how the AI market could splinter in 2026. That's been a key theme. AI beneficiaries versus cost centers. Disney box office hit $6 billion for the first time since COVID, thanks to Lilo and Stitch and Zootopia 2. Why Disney stock is the real winner from the Warner takeover battle. Fed survey sees about $220 billion in bill buying over the next 12 months. That is full tilt QE. Mortgage rates end 2025 at yearly low, signaling relief for 2026 buyers. That helps the housing theme. November pending home sales had fourth consecutive monthly rise. How hybrid models are helping keep automakers' electrification plans afloat. Why oil stocks are worth a bet in 2026. That's from Jacob Sonnenschein. We covered that. We continue to like our Comstock Resources and National Oil Well Varco, NOV. Again, this is all opinion, not advice. Go to hedgefundtips.com, click on terms. Boeing stock is on a roll. Why it could gain 25% in the next year. We love the sound of that. Warren Buffett stayed true to his ways in his final year as Berkshire CEO. He spent the year eschewing expensive deals, selling more stocks than he bought, and adding to the company's cash pile. Chipotle and other restaurant stocks had an ugly 2025. How they can recover in 2026, that's why we have exposure through Papa John's. Investors warn of rotten private equity as funds strike circular deals. We've talked about that multiple times. So while it's funny, all these headlines that are coming up, we've been talking about for months before they were news. It's in a wild year for markets. Investors did nothing. Who did nothing did just fine. And now you get to hear from Jeff Adams for the first time about one of our newest picks. We'll turn it over to Jeff.
All right. Happy New Year, everybody. I'm Jeff Adams, analyst at Great Hill Capital, and this week I'm going to be walking us through the article of the week, Turnaround on the Menu, Stock Market, and Sentiment Results. And we're going to be covering one of our newest positions, Papa John's. So let's get right down to it. Tom already went through the media this week. You can see here, free cash flow starting to reaccelerate and recover. Revenues are stabilizing on a per share basis. Sales, cash flow, earnings, dividend, all moving in the right direction. Getting close to a 5% dividend yield to weight. So, Papa John's is a new position that gives us a fresh slice of exposure to the restaurant space, a corner of the market that has been taken out behind the woodshed all year. You can see here consumer services, whether it's hotels, restaurants, or leisure, all beaten down to multi-year lows. Looking at a performance chart of the restaurant index, underperforming the S&P by 16 percentage points. We first went public with our Papa John's thesis during an NYSE TV appearance on December 3rd, 2025 at the 550 mark. Founded in 1984, Papa John's is a heavyweight in global quick service pizza with 6,000 restaurants across 51 countries. It runs a highly asset-light, franchise-driven model, 91% franchisee operated, with a North America concentrated footprint, roughly 60% of units, where it commands leading share in 11 of its top 15 markets. Lucky for us, the company spent the past few years tripping over its own feet. The 2017 founder controversy sparked a C-suite revolving door with 4 CEOs in 7 years and no real executional stability. Missteps piled up, most notably a marketing pivot that scrapped the local co-ops that built the brand in favor of heavier national spending that failed to deliver, just as the CEO behind the change jumped ship for another job. At the same time, the menu ballooned with complexity that slowed operations and distracted from what made Papa John's great, making high-quality pizza consistently. These self-inflicted wounds were compounded by rising input costs, a soft consumer backdrop, and aggressive QSR discounting, driving a 70% drawdown from the late 2021 highs and setting up what we view as an attractive turnaround hiding in plain sight. Our confidence in the turnaround starts with the right jockey now riding the horse. New CEO Todd Penegor is a proven winner in the restaurant space with more than 20 years of experience and QSR in his DNA, having grown up with a father who is a Wendy's franchisee. Most recently, he served as CEO of Wendy's from 2016 to 2024, where he led the turnaround by pushing digital, expanding internationally, and launching breakfast. Under his leadership, Wendy's overtook Burger King as the #2 burger chain by sales and delivered the 12th straight year of same-store sales growth, turning the stock into a three-bagger and earning high praise from Nelson Peltz for his tremendous contributions. Penegor has been in the Papa John's kitchen for a little over a year now, and before he even figured out where the coffee machine was, he started running the exact same proven playbook. He laid out the strategy and early progress recently on a podcast recapping his first year and the road ahead, which is well worth a listen. And you can check that podcast out here. The Papa John's turnaround isn't rocket science. It's back to the basics, blocking and tackling. Over the years, menu complexity layered far too many rhythm breakers that drove short-term sales, but failed to drive the repeat frequency that wins in QSR pizza. Penegor is simplifying the menu around core products, and it's already paying off, with core pizza sales up 6% in Q2. Consistency had also slipped, so something as simple as oven calibration, aka making sure every pizza comes out with the same quality and temperature, kicked off in Q1 and is already improving quality and taste scores. When the product improves and execution gets simpler, volumes follow. The digital pillar is just as important. With nearly 80% of orders coming through digital platforms, Papa John's should be leading, not lagging. To close the gap, Penegor brought in Kevin Vasconi, an old Wendy's ally who previously served as Domino's CIO from 2012 to 2020, a stretch when the stock turned into more than a 12-bagger as he built Domino's into one of the largest e-commerce engines in the world at the time, behind only Apple and Amazon in transactions. So you can see here a nice headline, Kevin Vasconi, the CIO who helped turn $16 billion Domino's Pizza into a digital success story, is leaving the company to join Wendy's, now Papa John's. We're already beginning to see Vasconi's fingerprints, a revamped app that cuts reorder time in half for favorite orders, which is 80% of volume, full delivery tracking rolling out system-wide, which will be at 100% by Q1 of 2026, and a loyalty overhaul for 40 million accounts that shifted from a clunky $75 spend for $10 reward to an easier 15 for 2 structure, driving frequency, repeat visits, and more than 50% higher conversion. These early moves are starting to deliver encouraging signs, with international comp sales up 7% in Q3, and the all-important North America comp sales beginning to stabilize and set for a recovery in 2026. With product quality rebounding and comp stabilizing, margins become the next leg of the turnaround. Management has identified at least $50 million in supply chain savings, with $20 million hitting in 2026, plus another $25 million of G&A savings, both fully phased by fiscal year 2028, and expected to deliver 100 basis points of four-wall EBITDA margin expansion from the current 12% levels. They're also accelerating North America refranchising toward a mid-single-digit company-owned target over the next 2 years, a capital-light pivot aimed at profitable growth with an 85-restaurant deal already closed recently. Put accelerating comps and margin expansion together, and we see a clear path to normalize earnings power north of $3 per share and a potential double over the next few years. And while we wait for the turnaround to play out, we collect close to a 5% dividend yield, the exact type of yield we expect to be in high demand as cash moves off the sidelines in the easing cycle. The dividend is backstopped by a recovering free cash flow, roughly $60 million year to date, and a solid balance sheet with 3.4 times gross leverage, well below the 5.25 times covenants, and no major maturities until 2029 to 2030. You can see here dividend a little over 5%, and while yield continues to be neglected. Not to mention, we expect a company like Papa John's to be a key beneficiary of a better consumer backdrop in 2026, something the market is giving zero credit for. There are plenty of arrows in the quiver to support that view, whether it's the easing cycle with more rate cuts in QE, federal tax refunds up 44% year over year to $517 billion, with households seeing up to $1,000 to $2,000 boosts, or the cherry on top being the potential $2,000 tariff dividend checks. If those make it over the line, Papa John's will have a line out the door and ovens running overtime just to keep up. Despite all that discretionary firepower, consumer sentiment sits at rock bottom levels, worse than COVID and the GFC, setting a bar as low as they come for upside surprises. And you can see here, federal tax refunds estimated up 44% year over year. Consumer sentiment washed out. Bottom line, this is a classic story of a strong brand that lost its way, now led by a proven operator restoring the basics. The asset-light model prints cash when run properly, and the right pieces are finally in place. We're happy to own the turnaround, collect the dividend, and let the rest of the market rediscover Papa John's at much higher prices. Here's a more detailed look at the business and turnaround strategy from this year's Investor Day. You can check that out, all highlighted with the key points. We also broke down most recent earnings, Q3 earnings, highlighting all the key points. You can go through those. And on to the 10 key points. Number 1, North America system-wide sales decreased 1.1% to $879.8 million, with total comp sales down 2.7%. Management noted the greatest order decline came from small-ticket web customers, and the majority of the comp pressure was driven by weakness in sides as soft consumer sentiment and a promotional QSR backdrop weighed on results. Core pizza sales were solid, with units up 3% and pizzas per order up 4%, although the negative mix shift left overall pizza sales roughly flat. 2. The international business continues its recovery, with system-wide sales up 10.3% to $331.5 million and comp sales up 7.1%, marking the fourth straight quarter of positive comps with sequential improvement each quarter. Management remains encouraged by what they see in Q4 and the long runway for expansion ahead. A key driver of recent growth has been the expanded croissant pizza offering into 3 additional markets, generating significant media buzz and activation. Number 3, management has identified at least $25 million of G&A savings through the ongoing review of the cost structure, with at least half expected to be realized in 2026 and further efficiency opportunities likely ahead. These savings are in addition to the previously announced $50 million of supply chain savings driven by procurement, vendor negotiations, freight and transportation improvements, and reduced fixed cost leverage throughout the commissary network. Together, management expects these initiatives to be fully realized by fiscal year 2028 and to deliver 100 basis points of restaurant-level profitability improvement across both franchise and company-owned restaurants. 4. Papa John's is accelerating the refranchising program over the next 2 years with the goal of reducing company-owned restaurants to a mid-single-digit percentage of the North America system, which is expected to strengthen local markets and increase operational efficiency. Management noted they already have a strong pipeline in place with existing buyers at attractive multiples, and the sale of the ownership stake in the JV operating 85 restaurants closed in Q4. The transaction is expected to reduce consolidated revenues by $60 million, but will have negligible impact on net income. Number 5. During Q3, Papa John's opened 45 restaurants system-wide, consisting of 18 openings in North America and 27 in international markets, bringing the total restaurant count to just under 6,000. For the full year, management expects 85 to 95 gross new openings in North America and 180 to 200 gross new openings across international markets. 6. Management addressed the M&A speculation during earnings. There were previous reports of $64 per share takeout bid from Apollo, knowing they remain focused on maximizing shareholder value, and they are open-minded about the path to achieve it. At the time, they stated the opportunity before the company to drive the greatest value creation is through the execution of the transformation strategy. We agree. We didn't get involved in the stock for a 50% takeout and are pleased to see management staying focused on long-term value. Number 7, management continues to make progress on the digital front, with the revamped loyalty program now accounting for nearly half of total sales and driving increased redemptions and higher order frequency. Total loyalty accounts have reached 40 million, up 1 million sequentially, and the delivery tracking service is expected to be fully rolled out by Q1 of 2026 and is already live in about 60% of U.S. restaurants. Number 8, Net cash provided by operating activities increased to $106 million year to date, with free cash flow of $59.2 million through Q3 compared to just $9 million in the same period last year. The increase in cash flow has been driven by the timing of cash payments into the National Marketing Fund, favorable changes in working capital, lower cash taxes, and reduced spending related to the international transformation initiatives. Number 9, management revised the full year 2025 outlook, now expecting system-wide sales growth of up 1 to 2%, down from the prior 2 to 5% range, driven by a softer consumer backdrop and a more promotional QSR environment that is expected to persist into the start of 2026. North America comp sales are now expected to be down 2 to 2.5% versus the prior outlook of flat to up 2%. Offsetting some of that weakness is international, with comp sales guidance raised to up 5 to 6% from the prior up 2 to 4%. Number 10, the balance sheet remains in a healthy place with total available liquidity of $502 million in cash and borrowings available under credit facilities and gross leverage of 3.4 times, well within the permissible limits of 5.25 times. And you can see here earnings call highlights. We went through those, highlighted, underlined with stars. You can check that out there. Now on to the general market. Fear and greed index staying neutral at 49. Equity exposure flat week over week at 100.7, a little stretched. And we are now open to smaller accounts of $1 million plus and will remain open through January 9th. To see if you qualify and to take advantage of this opening, click here. Larger accounts of $5 to $10 million plus can access bespoke service anytime here. Not a solicitation, opinion, not advice. That was a lot of fun going through that. I appreciate you listening, and Happy New Year. Thank you.
And we're back. Good job, Jeff. Let's go to earnings. Top 30 weights of the real estate ETF. Earnings power has been revised down by 81 basis points. Utilities revised up by 75 basis points. As far as the Ask Me Anything questions, we are going to defer them to next week because we've got a couple good, about 9 good questions. We want to get back to them when people are back from vacation so everyone can hear them all at once. A lot about 2026 themes. So we're going to keep this one short. Our last few weeks have been, 2 hours plus. Get you off to your new year, and then next year we'll catch up on the AMAs. For those of you who had sent them in, we'll cover yours next week. In the meantime, make it a great one. And by the way, we're going to be back, I believe, one day earlier next week on Wednesday. So check us out. We'll see you then. In the meantime, Happy New Year, everyone. Make it a great one, and bye for now.